Today in accounting chapter 3, we're going to talk about bank reconciliation statement. And when we talk about bank reconciliation statement, we're simply talking about a record that reconciles or checks the internal records of a business compared with the bank balance. So I'm going to read further. A bank statement is a document that records all the transactions that took place in the current account. So it's a statement that records all the transactions that takes place in the bank's current account. So that means there are transactions in the bank. The business has done transactions with third parties, has done transactions with other businesses or stakeholders, and at the end of the day, it wants to check if its book record is the same as the bank balance, and that's why we have a bank reconciliation statement. So what are the purposes of a bank reconciliation statement? The first one, to reconcile the balances of the bank statement with the balance in the company's own bank account record. So the first purpose of recording or having the bank reconciliation statement is to reconcile the bank statement that is being presented by the bank to the organization with the bank account of the organization. 2, to calculate the bank figure to prepare a balance sheet. Another reason why we need a bank reconciliation statement is to calculate the bank figure in the course of us preparing the balance sheet for the business, which is the financial statement. The third reason, to ascertain the amount the business has in the bank account or amount the business owes to the bank. So another reason why we need to reconcile our bank statement or to have a bank reconciliation statement is to know the debit balance and the credit balance. And if the bank reconciliation statement is stating a credit balance, it simply means that the business or the organization still has money in the bank. But if it's showing a debit balance, it simply means the bank is the business is owing the bank. That means there's probably an overdraft that the business has to pay for. So the credit balance, the business has money in the bank account. The debit balance is the business owes the bank through maybe overdraft. A bank overdraft. So what are the reasons for differences in the bank balance and the business's own calculations? What could bring about discrepancies in the bank balance and the business owns account, the internal account? Number 1, time delays. And when we talk about time delays, we're simply talking about time lags. So there might be delays in the course of recording the transaction and before it reflects in the bank statement. I'm going to read further. Time delays. There may be delay between the time of recording, the time the account was recorded, the transaction was recorded, and the time it appears in the bank statement. So there might be time lag between the time the transaction took place and the time the transaction took place, which the recording has to be done, and the time it's reflecting in the bank statement. That's one of the reasons. The second one, unknown entries, which simply means either the bank or the organization is aware that a transaction, neither the bank nor the organization is aware that a transaction has taken place. So here I have unknown. Either the bank or the business is not aware that the transaction has taken place. For example, maybe there's a bank charges or there's a dishonored check. The business might not be aware of this charge because it would have been done automatically through the bank, or a dishonored check, which simply means that the business has issued a check and the bank has dishonored the check, which simply means the business would have debited itself for such amount, but the bank has not debited the business, and that could also bring about discrepancies in the bank statement. And the last one, errors. Anyone could make mistake anyway. So the bank might have made a mistake, or the business would have made a mistake in the course of recording the transaction. So these are the reasons why we will have differences in the bank statements and the business's calculation. Then the last thing we need to talk about for today is the effect of bookkeeping entries in the bank balance. So when we talk about the effect of bookkeeping entries in the bank balance, we're simply talking about increase in the bank balance or decrease in the bank balance. So what would bring about increase in the bank balance, and what would bring about decrease in the bank balance? For the increase in the bank balance, any lodgements are made to the bank. As soon as a cash or check is paid into the bank account, it increases the bank balance for the organization. 2, any lodgements are made to the organization bank account by others. And also, if any organization or anybody pays, or any third party pays or lodge money into the bank account, to also increase the bank balance. It could be through interest, maybe interest received. Example, interest received. So this will also increase the bank balance. Then what will bring about decrease in the bank balance? Number one, any payments are made by the organization. As soon as the organization makes any payment, it will reduce the bank balance. Two, any cash withdrawals made by the organization. Also, that is payment will be to the third party or to other suppliers. That will reduce the bank balance or decrease the bank balance. Also, any cash withdrawal by the business itself to also reduce or decrease the bank balance. And the last one, any financial charges made by the bank. So there are some, maybe commission is charged or bank charges in the bank account will also decrease the bank balance. So in the next class, we're going to talk about the format of preparing a bank reconciliation statement and debits and credit in the bank account balance. Thank you.